Welcome to The Deep Dive, your shortcut to being well-informed. Today, we're plunging into the Q2 2025 earnings call from Churchill Downs Incorporated. You know, the company that mixes that iconic Kentucky Derby pageantry with a rapidly growing gaming and entertainment business. We've got the call details, the numbers, our notes. Our mission today, to really distill their recent performance and the big strategic moves they talked about, give you the clear picture.
Yeah, it's a really interesting one this time. The call gave us a great look at how Churchill Downs isn't just, relying on the Derby brand. They're being pretty aggressive pursuing new growth areas too. So we'll dig into what's driving this strong quarter and maybe what it means for them going forward.
Okay, so let's jump right in. The headline numbers for Q2. Churchill Downs really had, an impressive quarter. New records basically across the board. They hit an all-time record net revenue, get this $934.4 million. That's up a solid 5% year over year.
And that number, $934.4 million, it's not just big. It tells you that even comparing against, the huge 150 at Derby last year, they're still finding ways to grow. It shows they can drive sales, which is always a good sign.
Exactly. And their adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a key profitability measure, that also hit an all-time record, $450.9 million, up about $6.1 million from last year.
Right. And what's striking there, I think, is the consistency. Mm-hmm. This is the fifth Q2 in a row they've set records for both net revenue and adjusted EBITDA. It really speaks to strong operations, a clear growth path, even with those tough comps. They know how to manage the business.
Okay, and diluted EPS, earnings per share, came in at $2.99. Some market estimates actually had them beating consensus, maybe even hitting $3.10.
Yeah, beating EPS forecasts like that. It signals, efficiency.
Yeah.
Good profitability, good news for shareholders.
And looking at cash, they generated a pretty significant $455 million in free cash flow in the first half of the year. Free cash flow, that's the cash left over after running the business and reinvesting. It's crucial. That $455 million works out to roughly $6.29 per share.
Mm-hmm. That kind of free cash flow is, vital. Give them firepower to reinvest, pay down debt, return cash to shareholders. Mm-hmm. It's all about future growth and flexibility, right?
And speaking of returning cash,
mm-hmm.
They definitely showed confidence. They authorized a new $500 million share repurchase program. And that's after buying back over $250 million in shares just in Q2.
Yeah, that's pretty aggressive on the buybacks. It's not just random. It signals management thinks the stock is maybe undervalued right now. It's a clear way to boost shareholder value.
Okay, let's really dig into this quarter now, starting with, the crown jewel, the Kentucky Derby. Management laid out 5 key catalysts they expect will drive what they called step function growth for Derby Week starting in 2026. First up, ticketing and premium experiences.
This is, I think, a huge differentiator for them. That demand for the unique sort of high-end stuff, like the new Starting Gate Pavilion and Courtyard, it's incredibly strong. It's not just about filling seats. It's about getting maximum value from those curated luxury experiences.
Absolutely. They said customer feedback was overwhelmingly positive on those upgrades, and they expect prices and demand for those bespoke offerings to just keep climbing. I mean, over 370,000 people attended Derby Week this year. It's a massive week-long thing with different price points.
Yeah, and that positive feedback means they're nailing that aspirational experience people will pay top dollar for.
Yeah.
But they still keep the broader appeal, too. It's a smart balance.
Okay, beyond being there in person, the media side is huge. Let's talk broadcast rights, this new NBC deal. What makes it so significant apart from the obvious money?
Well, the new 7-year deal with NBC starts in 2026. It's projected to add something like $10 million in adjusted EBITDA just in that first year. But you're right, it's more than just the cash. It cements the Derby's place as a major national TV event for years. In today's media world, that's huge. Shows its cultural power.
And the viewership numbers back that up, right? The 2025 Derby had record-breaking numbers, nearly 18 million average viewers, peaking close to 22 million. Highest Derby viewership in decades, they said. Massive engagement.
That kind of audience is pure gold for a sporting event. It proves the appeal is still there, maybe even growing. It's a national moment.
Now, here's a really interesting strategic play. The Kentucky Oaks goes primetime. For the first time ever in 2026, the Oaks race, the big Friday race, will be broadcast in primetime on national TV, moving it to that 8:00 to 9:00 p.m. slot on Friday, May 1st. They see it as a deliberate catalyst. Boost viewership, wagering, sponsor appeal.
Right. And this isn't just tinkering with one race. It's part of that bigger strategy to like amplify the whole Derby week vibe. Prime time for the Oaks builds buzz right into Saturday. It creates this really powerful, connected series of events. It shows they get that the crown jewel needs constant polishing, both physically and in its media profile.
And the betting followed the viewers. Wagering growth also set records. All-time highs for betting on the Derby race itself, up 11%. The whole Derby Day card, up 9%. And the entire Derby week, up 6%. Their own platform, TwinSpires, and partners like FanDuel and DraftKings, record wagering there too.
Those betting numbers are key, obviously. Direct revenue impact, seeing growth across the board, especially online via TwinSpires, that suggests really strong engagement. From regulars and maybe new fans pulled in by the media buzz, it's a healthy core business.
Okay, last point on the Derby. Sponsorships and strategic capital investments. Sponsorships grew in 2025, and they expect that trend to keep going. They're pushing for more national and global reach, aiming specifically at those high-end international folks.
And those capital projects, they're not just for show. They're about making sure that premium experience justifies the higher prices and attracts that global, wealthy customer. It's like a cycle, right? Invest, enhance, charge more, attract more. No. Keeps the Derby exclusive.
Yeah, they mentioned major renovations like the Finish Line Suites and the Mansion are on track for Derby 2026. On time, on budget. And they're already planning the next big project, somewhere between the First Turn building and the Sky Terrace. More details next quarter, they said. Clearly not sitting still. Okay, moving away from the track now. Churchill Downs is pushing hard on its historical racing machine operations, HRMs. For anyone unfamiliar, these are kind of like slots, but the payouts are based on old horse races, casino feel, but at the track. This segment, it's now nearly 2/3 of their adjusted EBITDA for the quarter.
Whoa, 2/3. That's a huge shift in where their profits are coming from. It really highlights how vital that HRM segment is now. Shows their diversification strategy is really, really working.
And this HRM segment grew significantly, especially, they said, in Kentucky and Virginia. In Virginia, the Rose Gaming Parlor in Henrico County. Set for an October opening, ahead of schedule, on budget, building on growth they're already seeing there. Then in Kentucky, the Marshall Yards facility in Calvert City opens Q1 2026. Management sees a, quote, substantial runway in these states.
So this fast expansion, it does raise the question, how do they manage margins, right? There's a slight dip, like 1.3 points in casino margin at 8 of their own gaming properties. But they said that was strategic. They moved about 500 HRMs out of Louisiana into those higher growth spots in Virginia and Kentucky. So it shows they're actively managing the portfolio, right? Chasing the better long-term growth, optimizing costs, building up the customer base in new markets, smart tactical stuff.
And a big strategic move announced mid-July, acquiring 90% of the Casino Salem project in New Hampshire, $180 million cash. This gets them into the New England market. It's right on I-93 near Boston. Big potential. And it'll have both HRMs and full table games.
Yeah, the New Hampshire deal is really interesting. That location near Boston is key. It's not just grabbing something cheap. It feels like a calculated entry into a new, potentially lucrative region. Diversifies their gaming map. Big ambitions beyond Kentucky and Virginia, clearly.
And get this. They're also looking into viable alternative uses for a second HRM license that came with that New Hampshire deal.
No.
Hinting at more expansion there.
That's a crucial detail. Having another license gives them options, right? Flexibility to grow more in New England without maybe a huge extra cost. It's like a built-in strategic option.
Their tech side, Exacto, which powers the HRMs, that's growing too, partly from their own expansion, but also through deals with third parties in places like Wyoming and Kansas. A new third-party place might open late this year, early next. And they're innovating, developing a new HRM roulette product with Interblock. Always adding new stuff.
That innovation piece with Exacto is vital. It means they're not just spreading out geographically, they're pushing the tech too. Keeps the games fresh, competitive, could unlock new revenue streams just from new game types.
Okay, let's shift to capital management and the financial outlook. Marcia Dall, the CFO, laid this out. We mentioned the buybacks, $250 million in Q2, new $500 million program approved, shows management's belief in future growth.
And it fits into their disciplined capital plan, doesn't it? They prioritize, long-term Derby investments, building these high-return HRM places, smart M&A, and that consistent 7% annual dividend growth. Then they use buybacks strategically when they think the stock price doesn't reflect the real long-term value. Make sure it adds to EPS and free cash flow. It's a well-oiled financial machine.
They reported bank covenant net leverage at 4.2 times. Leverage, basically debt relative to earnings, a key bank metric. They expect that to drop below 4.0 times in 2026. Why? Because those investments in Virginia and Kentucky should start kicking in serious EBITDA and free cash flow.
That projection is important. A falling leverage ratio means improving financial health, more flexibility. It shows they're confident those big bets will pay off pretty quickly, become self-funding. Signals belief in their own growth forecasts.
And here's a nice tailwind. That federal tax bill signed back on July 4th. New rules making the 21% business tax rate permanent, 100% bonus depreciation permanent too, that lets them deduct big chunks of investments up front, plus reinstating a better interest deduction limit. Bottom line, they project it reduces their cash taxes by $50 to $60 million in 2025, and similar savings in 2026.
Wow, that's a serious boost. $50, $60 million less in cash taxes. Go straight to the bottom line, boosts free cash flow. It's basically free capital to reinvest or give back to shareholders, like finding money legally.
So what's the takeaway for you, the listener, this earnings call? It painted a picture of a company with really strong fundamentals and a clear multi-year growth story. Management sounded confident, handled analyst questions well.
Yeah, totally. They're bullish on pushing Derby prices higher for premium stuff, expanding the Derby's global reach. And they see New Hampshire as just a focused first step into that market, maybe more M&A down the road. This wasn't just numbers. It was like their strategic roadmap for the next few years.
And the market seemed to like it. Initial reaction was positive. Analysts mostly have strong buy ratings, price targets suggesting decent upside.
That positive reaction makes sense, right? Record results, smart expansion, tax tailwinds. It all adds up to a pretty robust outlook. They're actively building their future, tangibly, across the Derby in these new gaming segments. The market seems to believe the strategy.
One interesting aside. The CEO was asked about prediction markets maybe hurting horse racing betting. He kind of brushed it off. Said pari-mutuel betting is unique. You bet against others, not the house. And pointed to legal protections like the Interstate Horse Racing Act. Doesn't seem like they view it as a big threat. Okay, now for the part of our deep dive where we get a bit speculative. This is absolutely not financial advice. Let's be super clear. But if we were pitching an investment committee, here's an outrageous but maybe plausible trade idea for Churchill Downs.
Okay, let's hear it. Given everything we've discussed, the catalyst, the confidence, a long-term bullish view makes sense. But where's the angle? Where might the market still be missing something? Where's that alpha?
Right. My idea. Go long Churchill Downs. Buy a decent chunk of shares. We're targeting the potential for two specific catalysts, kind of interconnected, that we think are undervalued and could compound unexpectedly in 2026. First catalyst. We think the market is seriously underestimating the full impact of moving the Kentucky Oaks to primetime on NBC. Management's projections may be too conservative. We think there could be a halo effect pulling in a whole new high-value demographic to horse racing, specifically through TwinSpires. Let's forecast, say, a 25% unexpected jump in new player signups, maybe with higher spending per player just from that one move.
That's bold. But yeah, prime time for the Oaks. It could be a sleeper hit. That halo effect on TwinSpires signups is a really interesting angle, maybe underappreciated by the street.
Okay, second catalyst. Remember that second HRM license they got with the New Hampshire deal? Management said they'd evaluate and pursue viable alternative uses. We read that as a strong signal. We think they could deploy a second HRM-only facility quickly, low cost, in some untapped, maybe wealthy New England submarket. What if that delivered an extra, say, $18-22 million in adjusted EBITDA within 18-24 months? That's likely not baked into any analyst models right now.
Okay, I see where you're going. This strategy hinges on the idea that Churchill Downs, even being big and well-known, still has these kind of hidden levers, these under-leveraged assets the market hasn't fully priced in. Combining that potential media boost for the core betting business with a quick, profitable rollout of that overlooked second gaming asset, yeah, that could definitely lead to upside beyond what people expect today. It's about seeing the combo effect, not just the parts.
So let's recap this deep dive. Churchill Downs. Exceptional Q2 2025. Record financials. The Derby is strong and getting stronger strategically, and they're aggressively but smartly expanding gaming and HRM is. Plus, those federal tax benefits are a nice bonus, and their capital management looks disciplined.
Yeah, they've really set the stage for multi-year growth. The catalysts are clear. New broadcast deals, primetime races, new venues opening, tech innovation. The path forward looks pretty solid, leveraging that incredible Derby heritage, but also driving hard into these new growth areas.
Just a reminder, folks, this analysis is purely for informational purposes, definitely not financial advice. We hope this deep dive into the Churchill Downs call gave you some valuable insights, maybe sparked some thinking for your own research. We work hard for you, and we really appreciate your trust in tuning in. We'll be back next quarter to see how it's all playing out.
Until then, keep digging into those numbers. Always challenge your assumptions. And look for the story behind the data. There's always more to uncover.